All right. Good morning, everybody. Good morning, everybody. Happy Friday. Today is January 26, 2024, and earnings season just not going well, guys. It's just not going well. There's been a few bright spots. Netflix earnings were really good. A lot of subscriber additions. JP Morgan reported the best quarter of any bank ever. So those two were pretty good. Everything else has been really bad. Market doesn't care. Number go up. But sooner or later, I've been saying this for like the last week or so, sooner or later, earnings will matter. The whole point is to make money at the end of the day, right? It's not to just say the right things at meetings and make wishy-washy statements. No, it's the end of the day, this is about providing goods and services at a profit to your customers so that you have profits to provide to your shareholders. And, well, that's not going so well. Let's talk about the earnings that came in between last night and this morning because they were just all bad. Intel earnings, the big one this morning is Intel. Just terrible. Intel stock is getting pounded ahead of the opening bell. It was down 10% the last time I looked. Just every business model across the board in Intel just isn't going well. They're talking about right-sizing inventories for Mobileye. That's their autonomous driving chips. Well, things at the car companies aren't so good. See also Tesla earnings, which were just terrible also. Tesla guided down. Tesla stock took it on the jaw yesterday. Intel is getting it today. Also, Intel has been putting a lot of investments into artificial intelligence, but they've been doing onboard artificial intelligence, basically devices that contain the AI chips within them so that the task isn't sent out to some cloud computing firm somewhere that does whatever they want with your data. The idea with Intel's chips is that everything resides on the local device. Well, the market has not embraced that the same way it's embraced data centers like the big NVIDIA GPUs and the server farms that are full of them. So Intel just not looking so good this morning. Their numbers weren't terrible, but their forecast, their numbers were pretty terrible, and their forecast was terrible too. Intel just not having a good day over at INTC. Also, we got earnings from Humana yesterday, big health insurance provider, Humana, and we are seeing just terrible numbers from them. Also, big miss on earnings. Their stock was getting crushed. Their earnings and their profits are getting hammered by people getting elective surgeries. And that's something we saw the other side of that trade with Johnson & Johnson's earnings, where they were selling a lot more medical devices. And so J&J, another one of those silver linings in the earnings season this year, J&J was selling a lot of medical devices because a lot of people were choosing to have procedures done that they put off during COVID, during the pandemic, right? We've got a very much aging population here in the States. And so elective procedures should be rising year in and year out. But for 2 years, they fell off a cliff because old people didn't want to go to the hospital and pick up COVID. So now that catch-up is happening. Now that person who's been putting off that knee surgery, that shoulder surgery, that elbow that's been bothering them, they're all getting this done now. And it's jamming up the hospitals. Well, that's great for Johnson & Johnson, who sells medical devices. That's not so good for the insurance company who's supposed to pay for it. Emphasis supposed to, because anytime I go to the doctor anymore, I have to fight with some idiot on the phone over, hey, remember all that money that you've been taking from me for all these years? Now it's your turn to pay up. Oh, all of a sudden you have a problem with your network or with something and something. Don't get me started. I'm going to go on another rant. Anyways, Humana, it's time to pay the fiddler. They saw huge windfalls in COVID from profits from people paying their insurance premiums but not having any procedures done. Well, now those procedures are getting done, so it's killing their profits. Now, that's interesting, guys, because that also could mean we're looking at big increases in health insurance premiums in the near future, even though the Consumer Price Index has been telling us for the last 3 months or so that health insurance premiums have gone down by 34% year over year due to a sudden methodology change in the way we measure health insurance inflation. Well, if Humana's earnings are getting crushed by elective procedures, they're probably going to start raising their insurance premium. So maybe we get higher inflation prints in the future off of that, or at least it's going to put upward pressure on that one segment of inflation. Or the government will just keep lying about it and tell us it's 30% cheaper, when we all know that is clearly not the case. Visa earnings came out this morning. Visa is not doing so well. Their stock's not doing so well. Their earnings weren't terrible, but one thing that was notable in Visa is they showed a decelerating growth in consumer spending, both in debit cards and credit cards. Now, you got to get the language clear here, decelerating growth. So that means consumers are still spending more. It just means the increase in their spending is starting to slow down, as if this surge of retail and consumer spending, all debt fueled, mind you, is running out of momentum. And well, something runs out of momentum right before it starts falling. So Visa stock is not looking so good this morning because they are reporting decelerating growth. Again, still going up, but going up much slower now in consumer spending. And along the same lines, we got two more consumer spending data points today. We had Capital One reported their earnings, a 77% increase in charge-offs at Capital One. People are not paying their bills, and Capital One is starting to set aside money for that. They are bracing for that reckoning in the consumer debt market, a 77% increase in charge-offs at Capital One. They're starting to see delinquencies rise, notably in auto and credit card. Two sectors we've been watching on this channel. People took out, they signed up car payments that they couldn't sustain. I mean, the average car payment in America right now is in the mid 700s. And we've got a lot of people, I mean, a high percentage of car borrowers have car payments over $1,000 a month. Are you kidding me? And well, some of those people are not paying their bills, and Capital One is having to set aside cash for the eventuality that those bills end up being a loss. And also, same thing we got from Amex. Now, Amex doing a little bit better. They posted an earnings miss, but their guidance was pretty strong, mainly because American Express tends to cater to a wealthier customer. And well, the wealthier customers are still spending, right? The disparity between the bottom 50% and the top 20% is getting bigger and bigger. So while Visa is showing deceleration in consumer spending, Amex isn't really seeing that. But what Amex is seeing is an increase in charge-offs, much like Capital One is seeing that, a 40% increase in charge-offs for American Express. So, you know, American Express stock is doing okay this morning because they also increased their dividend. They had a 17% increase in the dividend for American Express stock. So that may be driving some of the buying this morning. But guys, all of these numbers, there's a few bright spots, right? The Visa numbers are still going up, even though they're going up slower. Amex is strong guidance. But the increase in the charge-offs, the increases in the delinquencies, look out for that. The surge of elective procedures at our hospitals being driven by an aging population, that could lead to increases in insurance premiums. So Humana is terrible numbers. Intel, one of our biggest chip companies, I mean, that's a $200 billion market cap at Intel, and they are down 10% this morning. Earnings season sucks, guys. I'm going to break it to you. This earnings season has been terrible. This stock market is drunk. It is absolutely drunk on hopium, on Fed pivoting. I don't know what you want to target, but they are drunk. Just taking it straight up, never looking back. 0 days to expiration call option. FOMO, bro. Oh, my God, you're just an angry perma bear. We've seen this story before, and we know how this ends. Charts that go vertical in one direction, go vertical in the other direction soon after. It's just a question of how high does it go before it hits its head on the ceiling. Could be tomorrow, could be next month. There's still $500 billion in the reverse repo. That is liquidity that is pumping into the market. That is still juicing asset prices. So, you know, it could go on for longer. It probably will go on for longer, but sooner or later, earnings matter. Valuations matter. Fundamentals matter, right? People said during the dot-com bubble that earnings don't matter. How did that go for you? AI Mania is going to do the same thing. With that, why don't we shrink my big melon of a head, guys, and let's see what's going on in the world of finance today. Don't forget that like button. It really helps with the YouTube algorithm. And if you're new here, guys, hit that like button, hit that subscribe button, hit that notification bell, and have your coffee with the melon heads every morning. We do this every business day. And right now, the S&P is down a paltry 1.4 points. Been bouncing around a little bit this morning. It was a little deeper negative earlier today, but basically stocks are unchanged, hovering right at all-time high to the moon, bro. The Dow is at, down 40 points, about 0.1% lower, just off of its all-time high. Again, congratulations, moon bros. Stocks numbers go up. Right now, down a little bit, though, just barely off its all-time highs. Considering how earnings season is going, this is phenomenal performance by the indexes, I would add, because there's been very little news today. And the NASDAQ is down 61 points or 0.35% lower. It's probably being driven by that big decline in Intel this morning. Again, though, the NASDAQ still a little bit off of the all-time highs, but doing phenomenal here. Looking over at the commodities board, we've got February gold futures at $2,024. That's up $7 this morning. March silver futures $22.92, down about a penny, pretty much unchanged for silver. Platinum is up 2.3% this morning, looking pretty good. Palladium is up just under 1% this morning, so the PGM metals are having a good day. And West Texas Intermediate crude oil March futures trading at $76.94, taking a breather for this morning. That's down about 42 cents after a couple of days of good performance for West Texas Intermediate. Looking over at the dollar right now, the U.S. dollar down 36 basis points, 103.22. That's down a little bit. I guess the market is starting to price in a little bit of a dovish Fed. I'm not really sure where the dollar weakness is coming from this morning. We have had some central bank actions overseas. It could be influencing that right now. But odds of a March rate cut are currently about 50%. So maybe the markets are pricing in a slightly dovish Fed here. Again, after yesterday's GDP print, I don't really get the whole dovish Fed narrative. Why would the Fed cut rates with unemployment low and GDP growing at 3.3% and risk bringing inflation back? If they're honest with us about what their priorities are, if their priorities really are to maximize employment and maximize price stability, neither one of those things includes juicing asset prices higher artificially. So why would the Fed cut rates here? Just asking the question. Let's look over at the bond market here. We got a little bit of a mixed bag. Yields aren't moving too much today. The 30-year down 1.7 basis points, yielding 4.364. The 10 years at 4.134. That is up just a fraction of 1 point. The 2-year is up a point and a half, 4.33. Watch that 10-2 inversion, guys. We are currently at about right around 20 basis points, a little bit below 20. Starting to close that gap a little bit there. The 1 month, meanwhile, at 5.388. That's up a point and a half this morning. So bond yields aren't really moving that much. And speaking of bonds, let's look at the reverse repo. We had a big drawdown yesterday of almost $82 billion in the reverse repo. Here's that step change down. Currently at $557.7 billion in the reverse repo. Still above our trend line, on pace sometime in March now to run out of money in the reverse repo. We are starting to see this trend line level off a little bit here, guys. I don't know if you can see this here, but we're starting to level off a little bit in the last few days. I don't know if that's going to correct with a big step down or not, but currently we're still on pace. We're still running out of money there. And remember, guys, this money flowing from the reverse repo into the bond market, this is very inflationary. Right, this is money that is not in circulation, that is re-entering circulation. This was printed in 2020 and 2021, but it hasn't been chasing goods or services or assets. It's just been parked at the Fed. Well, now it's draining from the Fed, chasing goods and services and assets in the economy. This is happening as the Fed is destroying money, but the decline in the Fed's balance sheet has been smaller than the decline in the reverse repo, which means it has been net liquidity positive since they started shrinking the balance sheet at the Fed. We haven't yet seen any of that quantitative tightening. As soon as this number runs out, that's when we actually start to feel it. So that's why I pay so close attention to this chart. Everybody will be talking about this one by the beginning of March, trust me. Now let's look at what's going on in China real quick. The Shanghai Composite Index was up again, just this time only about 0.14%. No big announcements about any new stimulus yesterday beyond what we talked about in the morning. So it looks like this little rally may be running out of steam. We have had 4 days in a row of positive moves in the Shanghai Composite Index. Of course, that's been small potatoes compared to the decline that we've seen over the last year. But notable difference here, guys, the Hang Seng, even though the SSE was positive, the Hang Seng, that's the Hong Kong exchange, which has a little bit less CCP influence. That one was down yesterday, another 1.6. So it looks like the Hang Seng, which has a little bit more foreign influence because nobody's worried about getting a phone call from the CCP if they sell too much in the Hang Seng. That one was down yesterday, 1.6%. So it's possible this little stimulus-fueled dead cat bounce that we've seen in Chinese stocks may be coming to an end. And Monday, pay attention to Monday, guys, the 29th. That is when we get our next court hearing for Evergrande. Will they liquidate the company and we finally get price discovery in Chinese real estate, or will they just extend and pretend and delay again? We'll know by Monday. Now let's talk about some of these earnings this morning because there are plenty. Intel seen struggling to find its footing as guidance miss sends the stock tanking. Bad news at Intel this morning. Intel Corp stock hasn't seen a double-digit percentage decline in more than 2 years, but it might break that streak after a downbeat earnings forecast. We're going to skip over the number specifics here and just let's get to this quote. While we expect to see slightly sub-seasonal first quarter from our core product business, we see material inventory corrections in Mobileye and PSG. That's according to Intel CFO David Zinger on the earnings call, referring to the Programmable Solutions Group. So, I mean, what is this corporate speak? We expect to see slightly sub-seasonal. I mean, is that a way of saying our business kind of sucks right now? Slightly sub-seasonal? Do you stick your pinky up in the air when you say slightly sub-seasonal? Is there a slightly super seasonal to offset this in some other business model? I don't know. I just love this corporate speak, isn't it? And also, when I see phrases like we see material inventory corrections in Mobileye and PSG, well, what the hell does that mean? Does that mean the inventory is going down and so people aren't ordering this? Or does that mean, hey, they're going to start ordering it any day now because their inventory has finally reached a low enough level where they're going to restock? So these guys, they speak, and I don't know if they hear the words coming out of their mouth, but this is probably one reason why people hate corporate America is because they use phrases like slightly sub-seasonal and material inventory corrections. Yeah, that's long talk for our business kind of sucks right now. Sorry about that. Sorry, your stock is down, everybody. Furthermore, the company anticipates a significant drop in Intel Foundry Services revenue as seeing accelerated purchasing in our traditional packaging business and cyclical weakness in wafer equipment buying in the first half of the year. Now, that cyclical weakness, semiconductors and chips, is a very seasonal business, I'll say. It tends to come in cycles. You know, the cycles are a few years long. You get these ripping monster bull markets. Everybody gets the next generation of chips. Everything balloons in valuation. Then reality sets in and the buying fervor tapers off. Reality sets in. The stocks give back a lot of those gains. They usually settle to a higher level than they started at, but you do see a lot of that bull market give back and the cyclicality among semiconductors. And Intel is starting to say, hey, we're starting to see that. Now that's interesting because if we're starting to enter that semiconductor winter season, well, pay attention Nvidia, pay attention AMD, all the other chip stocks that are just ripping higher nonstop. The whole sector could be in for a slowdown. Intel is starting to forecast that here. Another thing I want to mention here, guys, is artificial intelligence. They're mentioning this. Let me see if I can find it because I can only highlight one paragraph at a time. Okay, revenue from data center and artificial intelligence group was down 10% to $4 billion, while analysts were looking for $4.1 billion. So that's important because Intel is just not seeing the windfall from AI that its competitors are. Again, Intel has a different approach to AI. They're trying to make self-contained, smaller AI chips that can go into a phone or can go into a laptop so that you can host local artificial intelligence apps on your device instead of sending out commands to a server farm run by guys who used to trade carbon credits through shell companies, CoreWeave, and then they do what they want with your data, sell it to third parties, and send you back your answer. Well, Intel is taking a more privacy-centric approach with self-contained devices, and so far the market has been slow to embrace that, actually down year over year, $4 billion versus 4.1 a year ago. So Intel's not looking so good this morning, and the stock is paying the price down 10% ahead of the opening bell, trading at $44.55, down $5.02. Bad day for Intel. Also a bad day for Humana as their stock falls to a 4-year low. Company cuts 2024 guidance amid soaring medical costs. Boy, am I glad they made healthcare more affordable. Humana stock fell 13% on Thursday after the managed care company's quarterly loss widened amid soaring medical costs, and the company cut its 2024 profit guidance to almost half of what analysts were forecasting. The loss reflects additional increases in Medicare Advantage costs, which rose on higher than expected inpatient utilization, mostly in November and December. That's along with an increase in non-inpatient trends. Costs have been rising over the past year as many patients have started to have procedures that were delayed during the COVID-19 pandemic. Humana and rivals, including United Health, have invested generously in the government's Medicare Advantage program for seniors. Earlier in January, Humana warned that its fourth quarter medical loss ratio, a measure of premiums paid to cover medical expenses, had climbed to 91.4%, above the 89% analysts had expected. So people are just using their health insurance more because they're no longer afraid to go to the hospital and catch COVID. That is taking a big hit out of Humana's earnings because for years people put off those elective procedures. Not anymore. The stock was down almost 12% yesterday. This announcement was yesterday morning. I'm getting to it a day late here, but stock's recovering a little bit, about 0.5% up pre-market today, but this one took it on the chin yesterday. Bad day for Humana. Visa, meanwhile, posts an earnings beat, but here's why the street says the stock is falling. Visa sees an 8% boost in payments volume during the latest quarter. That 8% boost in payments volume may sound like a good number, but that is a lot less than the payments boost in volume last quarter. There's that decelerating growth. Visa called out resilient spending as it logged an earnings beat for the latest quarter, but its shares were still coming under pressure in Thursday's aftermarket action. The culprit, a slowdown in U.S. volumes into January, according to analysts. Mizuho analyst Dan Dolev noted that Visa's U.S. payment volume decelerated in the first quarter and in the first 3 weeks of January, a trend driven by debit transactions. Now, here, I apologize, this chart is pretty fuzzy here, guys, but this is showing the growth rate. This is important. Volume growth, total dollar value growth as a percent change year over year. All right. Now, one thing to note, this trend is still positive. The y-axis here goes from 2 to 8%. So these payments volumes are still growing. People are still spending more money than they did a year ago. But you'll notice since November, that growth has started to slow. We are spending more, but that increase is getting less and less. Sooner or later, that increase is going to get to zero. And if it keeps declining, the increase is going to go negative, which would mean retail spending starts shrinking. And that's when the U.S. goes into a recession. Now, this is Visa, guys. This is a really good snapshot of U.S. consumer behavior because just about every debit and credit card, with a few exceptions, is a Visa in this country. So this growth in a span of 2 months went from 5 to 6%. Now it's down to 3 to 4%, which would mean in another 2 or 3 months, this number could be negative if this trend continues, which would put us into a recession sometime in the next quarter. So this chart is forecasting a recession because consumer spending is about 2/3 of GDP. So consumer spending still rising, but it is rising slower. And by the way, November, that peak, that was Black Friday. That was all that raging talk about BNPL loans, about credit card debt. And Black Friday was so good and Cyber Monday was the best ever. Well, that seems like that was the peak for the U.S. consumer because we have started to decline in growth, mind you, ever since. And Visa stock this morning is down about 2.5%, trading at $265.34, down $7.27. Now let's talk about Capital One, another one having a rough day. Capital One charge-offs jump on auto and credit card write-downs. When you hear write-downs, you think people not paying their bills because that's exactly what that is. Capital One Financial Corp reported net charge-offs that were higher than analysts expected as borrowers fell behind on their credit card and auto loans. Remember, guys, it's the best economy ever. The credit card firm said that net charge-offs were $2.53 billion, a 77% jump on the prior year. Guys, people not paying their bills up 77% versus last year. Just I wanted to repeat that. Make sure everybody's getting that message. That's kind of important there. And that is higher, that $2.53 billion in net charge-offs. That's higher than the $2.36 billion that was predicted by analysts. Auto and credit card charge-offs ticked up on the previous year, as did delinquencies in both products. The company said in a statement, the firm boosted its provision for credit losses by $573 million to $2.9 billion. Now, that's interesting, too, because they're setting aside another $573 million for credit losses, right? So they boosted it to about $2.9 billion from about, I guess we were around $2.4 billion. So that's about a 20% increase in provisions for credit losses, even though net charge-offs increased by 77%. So the bank is setting aside money for more loan losses, even though loan losses are rising faster than they're setting aside money for them. Just an interesting little difference in the data there. But suffice it to say, guys, this is not a good indicator about the health of the U.S. consumer. Now, again, put that in the context of what we just got from Visa. They're showing that decline in growth. American consumers, the pain is piling up for them. They're still spending at breakneck pace, but they're starting to pay the price for it, and the banks are starting to pay the price for it. Capital One stock this morning is down about 0.75%. Things could be a whole heck of a lot worse for Capital One as far as the stock is concerned. Now let's talk about Amex, because some good, some bad with Amex earnings. American Express stock rises on strong guidance. The wealthy are still spending. And that's the takeaway there, right? The wealthy have not been hurt by inflation as much as the poor have. Nothing new there. We've seen that for years. But Amex, good guidance. They increased their dividends, so that's driving a little bit of stock buying this morning. American Express shares rose Friday after the card issuer reported quarterly earnings below estimates, so it was a miss, but they offered strong guidance and a dividend boost. Their fourth quarter earnings were $2.62 a share versus $2.64 expected. In the year-ago quarter, they reported $2.07 a share, so they are seeing earnings growth, not great earnings growth. But check out this paragraph. This is interesting. Total provisions for credit losses were $1.44 billion. That's rising from $1.03 billion in the year-ago quarter, reflecting higher net write-offs, partially offset by lower reserve build, the company said. Now, their loan losses went from 1.03 to 1.44, so we're looking at about a 40% increase in credit losses for American Express. That's on top of the 77% increase that we're seeing over at Capital One, on top of the deceleration in growth that we saw at Visa. So even though this was a good quarter for American Express, an earnings miss, but a strong guidance, and the strong guidance is overwhelming the earnings miss right now. The stock was up the last I looked. But that provision for credit losses, 40% increase in credit loss provisions. Guys, there is weakness being shown in the American consumer right now. Currently, American Express stock is up 2.4%. Again, that strong guidance and that dividend boost is probably in the driver's seat for Amex stock. So let's take the whole thing in aggregate here, guys, right? Intel, terrible quarter. They're losing the AI war, but their other business segments are also showing weakness. Humana getting crushed by people who have put off spending because of COVID. Now they're starting to catch up, and they're paying the price for that. So the economy is suffering from a little bit of normalization post-COVID, something that was a benefit for Johnson & Johnson, but it's really hurting Humana, which means probably higher insurance costs are coming for people. Visa, strong quarter, but decelerating growth in consumer spending. Capital One, terrible, setting aside a ton of money for credit losses, 77% increase in charge-offs. American Express, an earnings miss, but a strong guide with a dividend boost. But again, that 40% increase in loan loss provisions. Take this whole thing as a whole, guy. Earnings season sucks. This has been a terrible earnings season. Tesla, terrible earnings. Most banks, terrible earnings. So really, we've had Johnson & Johnson had a good quarter. Netflix had a good quarter because of subscriber growth, and JP Morgan. Those are really the only really solid earnings that we've seen in this whole quarter. Now, we've still got all the mega cap tech companies have to report. We've still got NVIDIA, Microsoft, Google, Meta, Apple, right? We still got the big dogs, and that's going to decide what the book actually records on this earnings season. But so far, there is a lot of weakness being telegraphed in our economy, especially those credit companies, man. The Capital One, the Visa, and the Amex earnings, there's some really worrying signs in those reports. And I want to say thank you so much to the inflation situation, sir. Thank you for the super chat and supporting the channel. He says, I'm just gonna throw it out there to the Mellon Nation. I heard Doomberg say diesel is a leading inflation indicator. Keep an eye on diesel to see where the 10-year U.S. Treasury is heading. Thank you, sir. I haven't followed diesel as closely, but let me just tell you, Doomberg, that guy, that chicken, has got one heck of a bird brain on his shoulders. I've listened to Doomberg's work, a lot of his interviews on other channels. He's fantastic, and he's absolutely right. Everything you buy goes on a truck, and that truck is powered by diesel. Everything you eat is grown on a farm that operates on tractors that run on diesel. I mean, diesel does make the economy go round. A lot of our Our train engines that move freight back and forth across the country is powered by diesel. So absolutely, diesel is a fantastic indicator of the economy. Now, that being said, I don't know what diesel has done for the last week or two because I haven't been watching it. But I can tell you the logistics industry has been in turmoil big time in the last couple of years. There's a website called FreightWaves. If you want to know what's going on in the logistics industry, FreightWaves has their finger on that pulse. We saw a lot of trucking companies go out of business last year, and FreightWaves was covering that very closely. If there was some kind of weakness like yellow trucking, FreightWaves had that story a month before it hit the mainstream press. So that's another good way to track that. And, you know, right up until the crisis in the Red Sea, which sent shipping costs rising throughout the world of logistics was really hurting. Now, because of the lead times being lengthened and the cost to ship around the Horn of Africa going up, the carriers are doing a little bit better. But the world of logistics has absolutely been flashing warning signs. Thank you very much. The inflation situation. I appreciate the super chat, sir. And thank you to the gray man who says, remember the Alamo. Okay, well, remember the Alamo. I guess we got a Texan in the crew here. It's good to remember the Alamo. That's good. Davy Crockett, very sad. Did I say something about the Alamo that triggered that one? I wonder. Did I accidentally say something Texan? I don't know, man. Texans are very, there's a lot of very Texas things going on in Texas. I remember I spent a lot of time in Texas, and they always said, I'm not from the States, I'm from Texas. And I was like, you know, Texas is a state. And they're like, oh, no, we were our own country at one point. And we still kind of are. So remember the Alamo. Okay, great, man. Thank you, sir, for the super chat, the support of the channel. And thank you, Grandpa says, dude, upgrade from DSL to fiber. Uh-oh. What's going on? Am I lagging this morning? Is my internet being wobbly? Sorry if that is going on, guys. I've got a couple of bars showing on my network here. I don't know if it was me or not. I guess the internet is not doing so well. We'll take that feedback, Grandpa, on the upgrade from DSL to fiber. I guess my internet was a little wonky this morning. Apologize if we're having tech issues, everybody. Thank you, Grandpa, for the super chat, the support of the channel. And thank you, everybody, for watching this terrible earnings season here on the Morning Update Live on my channel. Don't forget that subscribe button if you're new to the channel, guys. We do this every day. Thank you for the super chats, and thank you to my Patreon supporters for everything you guys do for the channel. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.